investing. I'm so happy to be joined each month by three of the more literate members of Better Investing. We have Mark Robertson from Rochester, Michigan, Hugh McManus from Pasadena, California, and Cy Lidge from Atlanta, Georgia. And Mark, I'm going to turn it over to you if you want to take it away, okay?
Well, that's pretty cool. We've got the whole country covered pretty well here. We do want to give a welcome to everybody and welcome to the March session of our roundtable, and it's dedicated to a little bit of March Madness, although we're going to try not to be too crazy with stuff here tonight. Ken, I assume we can see my screen okay at this point. Did I activate it properly?
I'm seeing it fine.
Okay. Well, let's go ahead and get the housekeeping out of the way, and then we'll continue with the agenda. Again, this is our quick reminder that everything that we do here is for education and demonstration, and no investment recommendation of any kind is intended. And we'll talk about real stocks in real time. And the reason we do this is, as a community, we like to deploy and demonstrate what we refer to as the tools of the modern investment club movement. And the four of us will be sharing various aspects of that as we go on tonight. Again, a welcome to people that may be returning, and good to see you again, and extra special welcome to those who may be joining us for the first time. Here's a quick look at our agenda. We keep it fairly simple. We will take a look back at the results that we've achieved. Again, we come together, the four of us, along with a few guest damsels and knights. Anne's here tonight also. And the task is really quite simple. We try to identify our favorite stock selections at any point in time. We've been doing it since a few Julys ago, so we will check in and see how that's going. Tonight's program will be a little bit special in that, you talk about March Madness, the four knights actually reached consensus tonight. Ken and Cy independently picked Priceline to present, and Hugh and I independently selected Intel. We'll, of course, be showing you how we ended up where we were and the results of our studies, but we basically have two stocks tonight instead of four, so kind of a first. Hugh's also going to embed a little bit of a presentation on what we entitled Checking Below the Surface, where he's basically talking about some of the underlying fundamental stuff. He'll be taking a look at some inventory considerations, and we'll do a brief presentation on that. And we'll be interested in hearing from you as to whether or not you'd like to hear a full 50 or 60-minute webcast on that subject. We will ask the audience to vote when we're done, and with that, let's go ahead and get underway. Here's a quick reminder about what we're doing here. The four of us, along with our special guests from time to time, come together to select our favorite investments. Our intent is to outperform the general stock market. And we're specific about how much. Much like the modern investment club movement, we want to outperform the general stock market by 5 percentage points over time. And we'd like to be correct or right. Our accuracy goal down at the bottom there is to be right 60 to 70% of the time. And the definition of right is just simply every single selection that we make, we basically continuously benchmark against the Wilshire 5000 since the time of purchase and for selection. And we'll demonstrate that here in a minute. We want that to be, we want our selections to outperform 60 to 70% of the time. Here's a quick look at how we've been doing, and as many of you know, we really liked this trend, which kind of set in at about the 2-year mark, where we busted into positive relative return territory. Again, relative return is what we focus in on. We want to outperform the market by the 5% that is shown by this dotted line right here, and we want to beat the market by 5 percentage points. You can see we actually made considerable progress and got up towards that line. We've slipped off the last couple of months. The type of thing that we often will see in kind of a hot market. A lot of times the ideas, especially some of the stuff that Hugh comes up with, needs a little bit of time to germinate and work, and it certainly has been working pretty well for him lately. We had our awards banquet, or our red carpet show last month, and we celebrated kind of this peak here that we see, and I do think the three of us have to tip our hat to Hugh, because he used to come in and just kind of take the lead temporarily, just enough just for long enough to take away our annual awards. And now he's put quite a bit of distance between himself and the rest of us. So he's hanging on to the lead this time. And we'll be talking about some of his picks. Our outperformance accuracy was up to about 60%. It has slipped back a little bit. Some of the selections that have been made have dropped that back a little bit. You know, for example, we picked 7 stocks last month, and all 7 of them have positive returns, but I believe only 4 or 5 of them have returns that have outperformed the market. So we keep track of that. Okay, this one's a little bit busy. We just want to make a couple of observations here. Anytime you want to see the stocks that have been chosen by this roundtable ever since July 2010, I believe, you can go to this public link. And again, you don't have to be a member of Manifest Investing. Just go to this link, type in this URL, and you'll see this. This is a portion of the table that you will see, the dashboard that you'll see displayed here. These are the largest selections, and you kind of have to decode it a little bit. And up here at the top, the repeat selections are listed. In fact, you know, Hugh has many of these Walgreen and Staples selections that you can hear 7-time selections. So when you see Walgreen down here, every single month we take and put $1,000 into every selection that is made, every decision that is made. So in the case of Walgreens, that's been done 7 times. So $7,000 is invested in Walgreen that you see here. That is now worth $10,400. So you can basically take any company in this table and figure out how much was invested. For example, Southwest Airlines shows up, I believe, twice here, ticker symbol LUV. So $2,000 invested in Southwest Airlines is now $3,000. So that's how you kind of decode the table, and you can see what the consensus favorites on that. Now, Hugh has been making a number of repeat selections, and that's why I was kind of shocked to find that he was picking a company from outside the portfolio, and it ended up being the same one that I was looking at. So kind of a shock. I thought I was safe from him by staying away from the repeat selections, but apparently it wasn't. Do you guys have any comments about any of these, or any observations about how some of these have done, or any outstanding issues before we go into the challenge?
Walgreen has done far better and faster than I expected.
Yeah, the one that I'd like to have a discussion on maybe next month or the month after is what exactly is wrong with Teva right now. It doesn't even match the dollars we've put into it, and I know it's a high quality stock, and yet we're barely making $3,000 on a $4,000 investment. And since we have Hugh with us, maybe he can give us some insight into what's going on with this generic drug company.
Yeah, I will dig into it. I'll look at it a bit more carefully.
Yeah, maybe we can take a look at pharma in general, and perhaps focusing on the generic side a little bit, and see if we can't identify maybe some macro type stuff that could be affecting Teva. I know I selected it a few times.
Mm-hmm. Yes, I have. And I don't have any great detail. I think the biggest problem with Teva, as I understand it, is the drastic concern over, and I'm sorry, the name of the drug is slipping my mind, but their multiple sclerosis injectable, which is one of their proprietary drugs that comes off patent, I believe, in 14 and 15. And the market has been very concerned about that. And then just as Hugh has alluded to, every now and then, it seems to be just a bit of concern over, maybe we're past the generic boom, although there is, I think Hugh also mentioned this last month, there is a bit of a patent cliff coming up in the next year or so, where name brand pharmaceuticals will be coming off patent, which of course gives at least some potential opportunity to folks as Teva. What I have mentioned anytime I've talked about it, from what I read, it's pretty big headwinds right now. You're probably not going to see any significant movement in Teva for, I would guess, a year to 18 months. But if they are able to take advantage of the patent cliff, as well as come up with some potential profit, more so than revenue, but profit replacement for their multiple sclerosis drug coming off
Copaxone.
patent. I'm sorry?
Copaxone's the name of it, yeah.
Yeah, Copaxone, yes. If they can get a replacement there, there could be some positives. I think probably the biggest wild card, and if it hits, it could be great for Teva. If it doesn't, it will probably continue to languish, and it will be a major mistake, and that's the biosimilars, which Teva's positioned reasonably well to take advantage of, if that comes to fruition.
Well, I'll tell you what, let's make a mental note. I'll do more than a mental note. I'll write down, and it's perhaps something we could spend some time digging into. I mean, while all the signs of an excellently managed company are there, it's certainly not anywhere near the challenge pile at all. So I think just digging in a little bit to understand what's going on there, maybe there's some institutional pressure we can explore also. All right, so with that, let's look at the other end of the list, and what we do is we sort by return forecast, projected annual return. This is a slide that Cy prepared, where we're basically looking at the whole portfolio, leaving out the stuff in the middle, the stuff that would be in the sweet spot and everything, and focusing our attention on the bottom of the list. And again, these are not bad companies. These are just companies where we need to come to grips with the types of returns that we're seeing. At the same time, as Ken often points out, there's not a, treating this as a portfolio by itself, there's not a whole lot of demand for attention here. The overall return forecast is sufficient. Growth is still pretty good too, and quality is pretty good. Cy, did you have anything you wanted to share on this slide as we kick into the challenge part?
Nothing. I mean, you've described it pretty well. The only things that I will point out in my presentation, I will be talking about a stock screen that I did, and that's what the circles, the growth rate, the 90% financial strength, and the 67% quality. What those circles are there for, just kind of make a mental note of those, and we'll talk about them later on.
Okay.
And I'll make a comment too about, say, Bank of America, which looks horrible there. You just look at its numbers. I viewed what happened 3 or 4 years ago, the proverbial financial storm, as creating a scenario where the Federal Reserve and the Treasury built a few arcs and crowded on those arcs a lot of financial companies. So they bundled them all together into Bank of America and Citibank and so forth and so on. And once we get through all that, I can't imagine that these large banks, these too big to fail banks, are going to be allowed to hold together the way they are. So I just think there's an extraordinary situation right now with banking, and I've been saying this for many years, that I've taken advantage of, but that it is not going to last, but I think it will be profitable.
Yeah, and the second part of our challenge will be to take a quick look at Bank of America, because Cy and Ken wanted to kick it around a little bit, but we're going to kick off with Adobe. But I do think that we'll take a closer look at exactly what you're saying there, Hugh. I think that you've obviously harvested some opportunity there already, and we can look at it from a fundamental standpoint too.
Well, I haven't sold any bank stocks at all.
No, and they've been pretty good to you. I expect they've been pretty good over years. Okay, let's go ahead and talk about Adobe Systems. This is the one. This is a company we've had in the portfolio, tracking portfolio, for a while. You heard us mention in the pre-session in the green room that it was selected first in July 2011. That was actually selected by Ann Manning. And again, this just gives you a little insight into what we take a look at. The average cost at the time of selection by Ann was $27.71. Here's yesterday's price. So we basically look at that total return, and this is an annualized number anytime these numbers are more than a year old. So annualized total returns on Ann selection are 30.2 during a period of time when the market has gone up on an annualized basis by 13.7. So her relative return is plus 16.5. Ken came along a few months later and made the second selection here, so it was doubled down on by Ken. at an average cost of $30.95, and you can see his relative return is also quite strong. Very strong contribution to the portfolio, but we've shared the Chronicle here. And Ken, would you like to talk a little bit about this?
Well, yeah, there's a couple of reasons why I'm looking at freezing the returns from Adobe, or challenging them and taking them out of the active pile, such as it is. First of all, the Adobe is showing me a trend in quality that I'm not real comfortable with. It's gone from an extremely high quality stock, that's that blue line, and it's kind of stepped down a couple of different times in the history of the round table. And it's down. It's not a bad quality stock yet, but I don't like the trend. I also see the par falling to, what's it, about 3% right now, I think the par is?
Yes.
This graph is around 5, but I think it's actually around 3 right now. I don't consider Adobe a core holding. I think that we've gotten excellent return out of it. We put 2,000 in and got almost 3,000 out. I think that's an excellent kind of return from a stock that I don't consider as a non-core, as a core holding in the portfolio. And because of that, I'm ready to close it out of the portfolio and look for some things with a little bit higher relative return. As I understand the arithmetic behind the portfolio, we won't lose these two returns in the total calculation, but they won't be moving up and down anymore going forward. Is that right, Mark?
That's correct. Well, what you see here for the relative return, those will basically lock in both of your individual accounts and in the overall composite that we displayed a few slides ago. So maybe we should get Ann to check in. We can get her in for a cyber standing ovation and see if Ann has anything to add to it. I know she's scratched her head over Adobe here fairly recently. We're putting her on the spot a bit.
Ann, you are unmuted, so go ahead.
And we know
you might be muted on your end. I'm not sure.
Because we know she doesn't have all these snowflakes to battle.
While Ann's trying to log in, Mark, I have a question from one of our Mid-Michigan folks. Martha would like to know if you could explain the pink-colored area of the Chronicle itself.
Absolutely. The pink-colored area is a running comparison of the return forecast. The return forecast is the par for any stock, so that's what you see here in this this red line is the return forecast over time. Notice that at the time that Ann selected Adobe, it was up here kind of near this peak, and then Ken came back a few months later. It was still actually relatively strong, and as we said, it's trailed off here lately because the stock price has gone up. Okay. The pink area is simply a comparison between that return forecast and the median return for the market. So it's the projected relative return that you see right here. Projected relative return. So again, over time, we're comparing the return forecast for Adobe versus the market. And the sweet spot, as we've defined it, is anything between 10 and 5. So anytime you see that pink area, anywhere between this 10 and this 5, it's in a nice spot. Typically for what we see, and you can see that both Ann and Ken made their selections under those, fitting those conditions. It was basically in there, and now what you see is a stock that is slated to underperform the market. Anytime this pink area is down below 0, you're looking at a stock that is projected to underperform the market. So it's actually quite a tool as you're scrolling through your stocks to be watchful for that sort of thing.
Ann, Manny, were you able to get your mic to work at all?
Can you hear me?
We can. We can hear you, Ann. Go ahead.
Okay. Okay, I'm sorry. I'm just personally ecstatic that the very first stock I picked for y'all, y'all might sell it because it did so well.
Well, take a bow. You're going to end up on the all-time leaderboard with that 16.5%. So.
Oh well. I'm very happy. If y'all want to sell it, it's fine with me.
Does this analysis bear up with some of the study that you've done here lately? I know you watch it pretty carefully.
Yes, it does.
Okay, so we're basically seeing a stock that the fundamentals have not strengthened greatly, but the stock price has surged pretty well. So,
Mark, we're also getting an interesting comment from Dan out of North Carolina. Dan says that Adobe has switched from selling their software to leasing it on a monthly basis. This lowers revenue and profits shorter term. So Dan is making the point that Adobe has somewhat changed their business model, I think.
Yeah, and I would expect that could be quite disruptive, disruptive good or disruptive bad. It would be my my head-scratching moment on that. Let's go ahead and take a look at the technicals on the company. We're going to spend a little bit more time on Intel here in a few minutes. But again, just to reinforce what the company has looked like here lately. And again, this is the period in time when Ann made her selection. She caught it at this bottom. And this is Ken's right here. And so you can see we've both benefited from both of those as it's gone up fairly well. And we're going to talk a little bit more about this later, but basically we're referring to any one of these type of patterns as a relative strength index break anytime it drops back below 70. And we'll talk a little bit more about it, but anytime we see that, we're not surprised to see a period in time that follows where either the stock price corrects significantly or it enters a trading range for some period of time. And that's what we're kind of showing there. And my message here is that for those of you that follow Adobe, perhaps even those that own it, Adobe is now in the range where it's going to have one of these someday. I don't know when. This can actually go on for years. But if we didn't sell it outright tonight, I would definitely urge us all to think about a trailing stop on a company that fits this pattern. It's been going, I mean, it's gone up, it's basically doubled in a little over a year, if you think about it that way. Any other comments? Yeah, go ahead, Ann.
Yeah, Mark. Oh, I'm sorry. Go on, Ann.
Okay. I know we're going to talk about Bank of America a little bit, and when we get to that, because you're probably going to mute me in a second, is how come Bank of America's ROEs and all that stuff is lower than Adobe? Would you not consider selling Bank of America also?
Well, we're actually going to talk about that, and we'll introduce the variable as to why we don't. We can actually boil it down into Hugh's rather pragmatic expectation about what profitability might look like for this company going forward. So I think we'll provide an answer to that. Well, for right now, just to remind everybody, it's kind of our standing rule now. We've adopted a United Nations Security Council protocol here. Any one of us can veto the freezing or locking in of the Adobe transactions, including Ann. But she's already indicated she's comfortable with closing out the position for now. Is there anybody that wants to veto the transaction? Ken, you recommended it. You're good with it?
I'm real good with it. Yeah, Mark. I do want to point out, Mark, another technical thing on this chart right here. You notice that as soon as I recommended Adobe, the price went down. That's called the wolves effect after my investment club, because that happens on every single stock we buy as well. So I just wanted to point it out. I know that a lot of you have the same issue that I do with buying stocks. So it's, you buy it and down it goes.
It's a wolves inverse bump.
The wolves effect, right.
So are you okay with it?
I am fine with it.
And we'll now ask Hugh, who is still smarting over Eli Lilly being closed out on him.
Yes, it did hit a 52-week high today. Yes, fine, go ahead with Adobe. Okay. I don't really know a whole pile about the company, but I do use the products every day. Which tells you there could have been an opportunity staring me right in the face.
Yeah, it's a good company. In fact, they've had a real nice crossover. There's some strength here. So a trailing stop for someone to be out there that own it. Those of you that do covered calls, that could be something to think about here too. But we'll go ahead and close that one out, and let's go ahead and move on to the next one. And
Mark, I'm going to break in for just a moment. Is there any way, Mark, you can boost your sound? We're getting comments from quite a few people that they're having a hard time hearing just you, that everybody else is pretty clear.
And you said I sounded fantastic earlier, Ken.
And you do to me, Mark, but evidently to a lot of the other folks, it's not loud enough.
Let me check my volume controls here. And is that any better from anybody out there that was asking?
It's breaking up really bad.
It is.
Yes.
Okay, and that might be your connection because I'm not experiencing that at all.
You want to mute me and see if that works better?
I'm going to right now. And we're getting, Mark, we're getting good in Sacramento, and Mark's sound is good.
Okay, so
so we're getting a number of good things here.
could be some isolated connectivity problems or something too. I'll check my internet connection here just in case. I'm not getting any warning, so let's go ahead and proceed, and hopefully that's a little bit better sound for everybody. I'm showing, well, now I am getting warnings. How am I sounding on you, Ken?
Mark, it's sounding okay. I think that we're just going to have to
Okay.
continue with what we have.
Let's go ahead and press on. If you lose me, we'll figure something else out. All right, so let's go ahead and talk about Bank of America a little bit, kind of following up on some of what Ann was just mentioning. Bank of America is a 4-time selection by Hugh, and one of them is quite strong, and the other 3 are still baking, still coming along. But what I thought we would take a quick look at is what you're seeing right here. That 44% is actually pretty cool. But what I did with a stock study, with a My Stock study at Manifest, is I put together a quick analysis, and this is kind of what it all boils down to, in my opinion. And please jump in, Hugh, if I mischaracterize anything here. You know, when you look at the analyst consensus on Bank of America, you're basically looking at a fairly low growth situation, which isn't a surprise. It's probably a little bit of an overreaction by the analysts at large, and also a relatively low return on equity. You know, and when you look at the overall financial sector, I mean, and you look at return on equity, I'm talking about all the money center banks and all that kind of stuff. You basically had right up until the great bear market of 2008, 2009. We'll just put a 2008 here. You basically had an average return on equity up here around 15 to 20. We'll just put 15, and then it took that nosedive down to like 5. We're talking about on the average now. And the big question is will it go back to something in between? And one of the things I wanted to illustrate here is then I think Hugh basically is sitting here saying he believes that it can return maybe not to the 15, but perhaps to the 10. What I want everybody to notice is the extreme difference in return forecast just by that one factor going from 5 to 10. And I think that's what we're seeing on the banks pretty much in general. Again, anytime you go through one of those great recession type moments, this stuff just gets absolutely wrecked. Book values and return on equity. So, you know, that's basically what you see is this, you know, we're coming through this trough period, and nobody knows what comes out the other side other than there's a pretty good bet that we probably are not ever going to go back to the levels that we used to see.
So I got booted out there for a second, so I'm back. Yeah, I think this is an exceptional situation with banks, and it hasn't occurred since the early 1930s. So it's difficult to know what these numbers mean. And I would actually expect them to return to where they had been in the past. They have a wonderful business model.
Yeah, I don't expect them to go quite all the way back up, but close.
But I also don't expect them to stay in the form that they're in right now unless there's some reason. They need to because they're competing with behemoths overseas, but the idea of too big to fail is kind of crazy.
Mm-hmm.
But in any event, this is kind of, I hate to say it's different than before, but in this case it kind of is.
Different this time, huh? Yeah.
Yeah.
Mark, will you explain the difference between the first line that just says Bank of America and the second line that says Bank of America Eagle?
Yeah, the first line here is basically what you pull in when you do a My Study. This is the analyst estimates, the current assumptions, and you can see that the only major change, I didn't change the projected yield. I should have done that, keep it completely the same. But the second line is my own study where I went in and substituted my own assumption for return on equity. to just test the sensitivity of that analysis. And again, take a look down here at the value line history for this is a Bank of America down here. This is the value line excerpt. And again, this is what he was saying. If you go all the way back to the early 2000s, these guys were flying along, you know, with huge returns on equity. And then the problem period hit, and, you know, basically we're still stuck in the mode of some of the analysts, especially some of them at value line, not expecting a return to the levels of the past. So I think this is kind of the answer to Ann's question. You know, you look at the sensitivity to that. I believe that 5 is too low. I believe that 20 is too high. I have no idea what the future holds, but I think it's something between them.
Yep. And their business back hasn't returned to where it should be.
No.
I mean, you can see by the rate on a 30-year mortgage, and there are other reasons that's depressed. But yeah, we're not back to the environment in which banks thrive. Their ecosystem is still poisoned.
Still pretty messed up. Yep.
Yeah.
And then one last slide that just kind of makes the point of how bad and how disastrous the situation is. This is a 10-year chart looking back month by month at just the tremendous pressures that it came under around that Great Recession, and then this mess that hit. Just a terrible situation where it's basically been eking back during that time frame. And here are the 4 selections by hue, this one being obviously the one that's been most successful. And my interpretation of this is I think they finally made it out of the woods with what you're seeing on the right-hand side. I mean, with this moment in time, this green arrow, this moment in time is where they finally started turning the corner, and that was late 2012, actually late 2011. And they actually are now headed in the right direction. You can see they're nowhere near overbought. All right, so we're about a half hour in. Let's go ahead and proceed with our stock selections. We can come back to this in the Q&A section afterwards, but let's go ahead and start off with Ken and Cy. And I guess we should say happy birthday to Captain Kirk. It was his 82nd birthday, I think, the day before yesterday. It's hard to believe he's 82, but he's sure cranking along. Take it away. I believe Ken's going to go first.
All right, and I'm going to take the screen, Mark, if that's okay with you.
Sure.
And what I hope you're all seeing now is a traditional stock selection guide. I'm using Toolkit. I'm using the Better Investing data. And what I'm presenting tonight is Priceline.com. I was really surprised to see that Cy had chosen exactly the same stock. We did it independently, and I think what we're going to do is after Cy adds his comments to whatever I have to say, we're going to compare our judgments and see how close our judgments actually are to each other. We haven't discussed them at all prior to right now, so let's see how close we come to each other. Priceline is an aggregator of travel services, and I'm sure that most of you are aware by this time of all the different travel services that are available online. We know of things like Orbitz and Expedia.com and TravelZoo and all kinds of these different travel sites, and Priceline is one among many. I don't know if many of you understand that Priceline has changed its business model fairly recently. Priceline's business model used to be that you would ask them for a particular kind of lodging or a particular type of service, and they would guarantee that they were going to provide you with that general type of lodging, and then you would name a price. And they would bargain with you, and if they could meet that price and give you the kind of lodging that you specified, they'd match you up and you'd have a place to stay at the price that you named. That wasn't something that a lot of folks liked to do, that bargaining back and forth, and so Priceline basically has kept that model. You still can bargain with them if you choose, but you can also now go and find a whole list of hotels at various prices and make your selection of hotel or plane fare or car rental or cruise ship fees or whatever it is you're going to deal with on travel. So you can do both choices right now. Priceline has also made a major purchase recently. They've purchased the website Kayak. Kayak was a site that I use and I still use extremely frequently. It kind of pulls all of the sites that give me different choices together onto one site, lets me compare the best price from the different types of travel sites and then move there to make my purchase. Priceline has not closed the deal with Kayak, but they've been approved by the U.S. Trade Commission to make that merger with Kayak, and they're undergoing some scrutiny right now by a couple of the European entities that have to give approval to make that kind of a group pulled together. So all in all, I think that Priceline is a slightly different company than you might have anticipated even a year or so ago. What I see is a company that has a lot of room to grow in Europe and in Asia. Priceline has devoted most of its efforts towards the United States right now, so I think growth, there's an awful lot of the world yet to move into as far as Priceline is concerned. I love the up, straight, and parallel lines, the fairly flat sales line for the last 7 or 8 years gives me a lot of confidence that the front end, the top line of this company is fairly secure and growing fairly rapidly. I've estimated growth in sales at about 20%, and then I've used the preferred procedure to come up with a growth in earnings of around 18%. I did adjust margins upward in the 32-cent range. I also adjusted taxes upward. I don't normally deal with tax adjustment at all, but I felt that the most recent tax number that was in the preferred procedure was a little bit low, so I boosted it. That's a wild guess, folks, at 23%, and it could be almost anywhere, especially considering that I'm not quite sure why Priceline did not have to pay taxes in some of these years. I left the shares outstanding at the default value, and that's where my 18.5 comes from in the revenue estimate. That's another name for preferred procedure. The analysts, if you caught the analyst number, I'll click here again. If you caught the analyst number, their consensus growth rate for the next 3 or 4 or 5 years is around 22%. So I'm a little bit more conservative than the analysts as far as future growth in earnings is concerned. I love this set of values here for earnings, for margins on this company. When they began, this company was working on very, very slim margins, a penny or two, and today they're working on margins of 33 cents on the dollar. Extremely great growth in margins. That won't continue forever, but it's a great trend as long as it does continue. And if it stabilizes around 30, 35 cents, I'd be very happy. Return on equity, just exceptional at 50-plus cents on each dollar, so I'm very happy with that. And they do carry some debt, but the debt seems to be manageable. I've just to play around with averages, I've struck out a couple of the years, basically a little bit of strikeouts occurring immediately after the recession, and I've decided that going forward I'd be comfortable with a 28 at the high side and a 17 at the low side. Add those together, divide by 2, that's about a 22.5 future PE. And if I look at Value Line going forward, that's exactly the number Value Line predicts 3 to 5 years for an average PE as well. I didn't look there first, but I'm happy to see that I'm on the same page they are. I did adjust. I think that this is the fiscal year number. It's just different because of a little bit of rounding going on. So I adjusted for whatever they called for there. I am getting a buy for Priceline. I'm getting about 16%. And I think when Cy shows you the manifest analysis for Priceline, I think that you'll see that the 16% is within a 0.5% of where manifest thinks that Priceline is going to go as well. So I'm going to add PCLN, Priceline.com, to the portfolio and turn it over to Cy.
All right, thank you, Ken.
I'll go ahead and switch back to me too.
Yep, go ahead and do that, Mark. While you're doing that, I'll just make one comment as far as the business financials that Ken mentioned. He mentioned a little bit of debt that you saw there. While there is debt, the actual they have current assets and cash equivalents that is about 5 times that amount of debt. So while from a balance sheet standpoint there's debt on it, they could turn around if they wanted to right now and pay it all off.
Absolutely, Si. Absolutely.
So it's a very safe situation. What I wanted to spend my time on, I'll briefly let you know how I came up with Priceline, and then I'll give you my judgments, which, as Ken mentioned, were arrived at completely independent of his. And it's interesting to see both how similar, but also how you vary a little bit and come up with the same bottom line, which is that it's a good, solid company to buy right now. What I did first, if you recall, I mentioned Adobe earlier having an 8.8% growth rate, a 90% financial strength, and it was about a 67% quality. You see, I have set up a stock search screen with I upped the quality to 80 because I wanted to look at an excellent company. Adobe was in the good range, a little below that, but I did tighten it up to excellent. But then the 90% financial strength and 8.7% growth. And to be honest with you, I'm not sure why that's not 8. Oh, because sometimes in rounding on manifest, you'll miss it right at the 8.8. So I notched it down to 8.7. That's why I did that. So essentially, I was looking for a replacement for Adobe that would give me a better quality and, of course, a higher return. And this is the results that you got. These 23 or 22 stocks that you see, the grayed out stocks, I didn't do it so dark you can't read them, but I darkened them out. Those are already held in the portfolio. And tonight I decided that I'd be looking for a new stock. So then I just went down the stocks that were left. C-Trip is a Chinese company. I haven't quite gotten over my hogs problem with Chinese, and therefore I decided that I would pass on Chinese. Interestingly, though, C-Trip is a travel site. Gets much of their business from that. Moving on down, Gentex is a company I have owned over the years. I don't currently own it, and have been very impressed with overall. I passed on Gentex partially just because of economic unease in my gut, but also since I was looking for an Adobe replacement, I said if I can find a technology company sector, I'll do that. Though Gentex was certainly a strong consideration. Apache and Schlumberger, similar to my C-Trip passing, I decided to take the plunge a few years ago into oil services and decided to buy an oil service company right at oil being at $150 a barrel. And needless to say, my investment did not do very well, and I haven't yet quite gotten over that one. I've for years and years felt that oil was essentially a commodity, and you could trade it, but you couldn't invest in it. And so I decided to pass on Apache and Schlumberger, which brought me to Priceline. So that's Agree or disagree, that was my logic on how I got the price line for tonight. Next slide, Mark. And then here are my judgments. I used the stock study Eagle feature at manifestinvesting.com. Ann Newman was asking about that earlier. Mark was showing you the bottom line results of him going in and using this tool to analyze Bank of America. This is what it actually looks like if you do click on the My Stock Studies tab and go in and do one, as Mark did and for Bank of America and as I did for Priceline. This is what it looks like. Notice I used sales growth somewhat lower than Ken's at 17%. I arrived at that simply because that's the low end of management's expectations for the next quarter. I think anywhere in the 17 to 20% range is reasonable. Management only gives guidance for the next quarter, so you don't get a 5-year or multi-year guidance, but I just chose to take their low end guidance going forward. The net margin, as Ken pointed out on his stock selection guide, and as you can see on the net margin slide or graph right to the right of my slide, you see that net margin has been going up significantly. Both Value Line and Morningstar expect that trend to continue at least into the 30 or so %. I chose to just accept it to stay flat. Not continue going up, but to just flatten out at a quite nice, comfortable net margin of 25.2%. I took the Value Line share estimate of 53.5 million shares, and that gives me an earnings per share of 56, which I believe Ken came in somewhere around 58, if I recall correctly. Notice that Ken and I came up with just about the same PE forecast at 23. I think his may have been 22.5 or so for his average PE forecast. That is an average PE. I'll just let you know I did do a stock selection guide that went behind some of these numbers, in particular the PE number, although I also felt the 23 didn't look too bad based on the graph that you see there on the right side of the slide. But I got somewhat different high and low PE than Ken did to come up with that 23 average. And what I did, I took the median for the last 10 years, median high and the median low, and then took the average of that, which was 23. And so that was somewhat of a different methodology than Ken used, but notice we ended up with virtually the same ultimate result, and that gave me a projected annual return of 13.3%. A little below the manifest defaults of 15.5 and a little below Ken's, but we're in the same ballpark, as you would say.
Absolutely. Well, thanks, guys. Okay, let's go ahead and finish up with Intel. And as we said, though, we actually ended up at the same place. Hugh McManus and I both ended up selecting Intel, so we'll let Hugh go ahead and present his case first, and then I'll come back and provide some other thoughts. Go ahead, Hugh.
I'll go through these at a pretty sharp, brisk pace, but I think everyone is pretty familiar with Intel. It's suffering right now. It's mainly associated with making microprocessors for the PC market. It is in other markets, but it really isn't in the tablet or the handheld device market to the extent that some of its competitors are. So it's suffering from that issue right now. PC sales aren't growing as dramatically as they once did. So if we move on to the next slide, I'll show you, I think here it should be the stock selection guide, and you can see that while sales are growing, they're not growing that dramatically, and this is a cyclical company, so as you would expect, once you hit a recession, sales tends to follow the business cycle. The historical growth rate is about 5.5%, and so going forward, I chose 5% sales growth as something that would be satisfactory. The company makes the internal guts, the machinery, for servers and the like. So this company is not going away. And even if there is a migration to cloud computing, the hardware for that, to a large extent, will be produced by companies like Intel. It's one of the behemoths in this industry of about 5,000 different companies, along with Advanced Micro Devices, which kind of is in the same ecosystem, and a few others. It really is the leader. But I think now we're seeing the effect of migration away from PCs to other platforms. So on the next slide, it shows part 2 of the stock selection guide, and both the ROE and the pre-tax profit is up. The company does have higher ROE than its peers, but its ROE has been languishing a little bit recently, as has its profit margins. Both bad signs. As I said, I picked 5% going forward, and you can see the other figures I included. It is cash rich, so its dividend I don't think is imperiled. Don't know to what extent most of the cash is overseas, avoiding the corporate tax in the U.S., but I don't anticipate any problem with the dividend. I've had a fairly conservative projection for the future high and low PE ratios of 14 and 9 respectively. And you can see in parentheses at the end of each of the lines below information about the historical growth rate, the current number of shares outstanding, and they have been buying back shares with close to 6 billion shares a few years ago, a few being 5 to 10. You see the range for the recent high PE ratio and the recent low in the last 3 years, and the low stock price that the SSG that I did projects. I actually picked a low stock price of 16. And at the bottom you see the range, the price range. It's $19 to $29 and change. And the next slide shows part 3 of the stock selection guide. We're playing around with the PE ratio, which I discussed already. I don't have really any worries about the stability of the dividend, but there is a nice healthy payout ratio there. And finally, on the next slide, you will see that it is in the buy zone, 3.4 to 1. And that's including a fairly, I think, aggressive idea as to how low the price per share might go. And the full return is on the slide that follows, slide 19, but it just shows that it's forecast to be 13.9 to 16.9% in that range, depending on whether you use the median or the high PE ratio. Sorry, it would be the average PE, not the median. And Value Line has a bit of a more aggressive. Value Line has given it a very bad timeliness figure of 5, and the reason for that is the transition that is occurring right now, but they still think the transition in the marketplace, they still think that Intel will catch up. And I do own this company and have for many years in my personal portfolio, so I've been adding it recently through ShareBuilder. So on the next slide, we look at the information from Manifest. Here we have, I guess, a conservative par of close to 14%, but staggeringly good quality of 97. It's in a nice spot. More aggressive sales growth forecast than I had of 8.7, so there is upside there, and a projected average price a lot higher than mine, I believe, of 35 and 50 cents, 35.5. So all in all, I think the company looks in pretty good shape, and the slide that follows has the rest of this equity analysis, where you can see that while the projected annual return is kind of languishing recently, the quality of the company has been improving steadily over time. And it has given reasonably good opportunities to buy it over the past few years. Yep. And then on the next slide, I was going to talk a little bit about inventory analysis and looking at receivables and sales as a way to try to predict the future. And we all know the future isn't certain, but still businesses must make decisions. And it's when they're wrong that you can extract some useful information about what you think might happen in the future. There are risks involved with inventories, especially for inventories in the microchip sector. And by the way, this analysis clearly would only work for companies which keep inventories. It doesn't work for service companies, which the majority in the economy right now. So if an inventory has a long lead time, there's risk, and an inventory item, so you have to buy it well in advance. And if there's a risk of it going obsolete quickly, as happens in electronics, there's also risk. And so the technology sector tends to be very generous in helping investors predict what could happen in the future if you track inventory, sales, and receivables. And the next slide talks a little bit about the fact that companies run on credit. So I'm talking about receivables here. So a company doesn't get the cash when it ships the product. It extends credit to its businesses, in the case of Intel, and writes a receivable that's an asset, and that's reported on its balance sheet. And if you see that receivables are growing, it means that customers are getting slower and slower to pay. Or it could mean that there's heavy discounting going on. Companies are trying to move material as quickly as possible. But monitoring receivables, particularly in the context of inventories, we'll just show that in a second, is a powerful way for knowing really what's going on within the company. And then if we move on to slide 24, all inventory isn't equal. And for companies such as Intel, where certain different types of inventories is material, it's usually broken into two and sometimes almost always actually three or more parts. You'll generally see raw materials, work in progress, and finished goods. And depending on the industry that you're in, you may be broken further. And on the next page, I've taken something from the recent annual report from Intel that actually breaks it into these three components: raw materials, work in progress, and finished goods. Very easy to read, but what does this all mean? And I'll just illustrate it on the next slide. Or we have a company that makes omelets. And clearly, you have to buy eggs. Those are your raw materials. Once you crack those eggs open and put them in a bowl, that's your work in progress. There is no going back. It's hard to get a yolk and the rest of it back into the shell and to get the shell where it was when you bought it. So you're committed at that point. Now, you could actually change your mind, and instead of making an omelet, you could use it for cake batter or a bunch of other things, but it is work in progress inventory. It's going forward, not going back. And by the time you make the omelet, you better hope that there's somebody there to eat it. So you have to be able to predict the future. You certainly have to have the chickens all lined up to lay those eggs well in advance, and you have to make the batter, mix the omelet batter in time to get the thing going. And by the way, I don't like the way Windows wants to spell omelet. It has too few T's as far as I'm concerned.
That's right. Here, we'll fix
I just don't like it. It's offensive to me, but what can you do? I don't like it when it bleeds either, puts that red line under it. So let's think of a company. When sales are booming, you're going to see the top line increasing steadily. You should see finished goods inventory drop. So you divide it into the three components: raw materials, work in progress, and finished goods. And you'll see that drop because customers want more and more material. It rushes out the door aggressively. You might see raw materials increase dramatically because the company is expecting to make more material to sell it to its end customers. And you could even see receivables drop. And the reason I'm saying that is that even though the company is doing more business, people are paying faster because they want to buy more and more product. So the receivables number would drop. And it's usually, by the way, expressed as a ratio. Receivables divided into sales. A bigger number is generally better. And then if you move to the next slide, we can talk about what happens if business turns south, and particularly in a business where things go obsolete pretty quickly. Sales might be flat or even start to decline, but there are examples where sales could still grow, and you will see signs in receivables and inventory that there are problems ahead. A finished goods inventory would start to pile up because customers don't want it anymore. The economy is slowing down, so they stop buying. The company might actually start to discount, so receivables could actually start to shoot up as they try to push product out the door. And you will see raw materials inventory drop as well because the company knows that 6 to 9 months it's not going to be able to sell product. So there's a lot of strange things that can happen, but if you monitor them, as I've done in this slide, you can see sales, you can see the accounts receivable turnover ratio, which is sales divided by the receivables. And then you look at the change in raw materials, work in progress, and finished goods. And this is from a given quarter, like on the bottom line it says the fourth quarter of 2012, compared to the fourth quarter of 2011. And here you clearly see that things are slowing down for Intel. Sales numbers were doing very well in 2011. Now they're starting to slow. You can see the accounts receivable turnover was increasing a little bit, but now it's back to a more manageable level. And just by way of comparison, in the glory years of the 1990s with the dot-com boom, this number was 1.5, 1.6. Material was booming out the door, and people were paying their bills quickly so they could order more material. You can see that the company has cut back aggressively on raw materials, and work in progress is piling up, but they have managed to avoid a pileup in finished goods. But things are slowing, and the stock looks as if it's going to languish for a while, which is fine by me because I buy these things for months and months on end. And then eventually the market catches up, and I can't afford to buy it anymore because it's not cheap, like me. And by the way, various things can impact inventory. So when you're looking to try to get an idea if the economy is slowing down, it's good to look at other companies just by comparison to see what's happening there, not just one. So Mark and I have talked about doing a workshop on inventory analysis, receivables, and sales analysis, and give examples so you can learn how to do this. So I just throw this there as a bit of a teaser. So Intel is a leader in its space. The stock price is languishing and may continue to do so, and sales will likely continue to drop, but I will continue to buy this company as long as its core fundamentals don't become disastrous. I think it's a stock for the long term, and I think it will continue to grow.
Okay. Well, thanks, Hugh. I'll jump in and finish off Intel, and then we can kind of close things down. Well, much like Si, I also like to share where the idea comes from. And what I did is I went and looked for the companies that are the best in the Manifest Investing database from a return forecast perspective, quality ranking, and a little bit of technical. That would be some of the sentiment indicators, the relative strength index, and that kind of stuff. And literally came up with a short list of 12 companies. A couple of things I'd like to point out. Now, Si mentioned he has an aversion to some of the energy companies, the oil and gas companies, but I do think it's a kind of a nudge or a prod because he had a couple other companies, and we see there's several showing up here. And might be worth tinkering around and studying those industries, looking for some opportunity there. The price points are probably different than at the time that Si got damaged by the situation. You see C-Trip coming back here, a couple other different companies, some long-term community favorites down at the bottom. These are all three of these are in the Manifest 40, including Intel that you see there. So just some interesting companies to kick around. We have talked a little bit in recent months about AVAV, ticker symbol for AeroVironment. That continues to look kind of interesting. It's going through kind of a bearish mode right now. This is definitely one that's going to probably garner more attention, along with Expeditors. Expeditors is here because it has excellent quality, decent return forecast, but it's at a real nice technical point. And that's how it ended up on the chart. Very few companies looking good from a technical standpoint on the buy side right now. So just Intel showed up here, and that's how I ended up taking a closer look at it. Again, just to repeat, quality's going up. They continue to improve. Their growth rate versus the industry is pretty strong. Their profitability is pretty strong, and their financial strength is virtually unmatched in their industry. And so they maintain a fairly high quality rating despite the cyclicality of their business. As you mentioned, there have been a number of buying opportunities, as we were talking about just a few minutes ago. Some of these spikes up in both the return forecast and the relative return have actually presented some pretty decent buying opportunity. Here's another peak right here, a decent buying opportunity. And right now the stock price is actually languishing a little bit from where it was not that long ago, and hence this little bit of a upturn in the long-term return forecast. So again, I see characteristics that are pretty strong. Anytime I get involved with a company like this, I do like for the projected annual return to be near all-time high levels, and that certainly is the case, at least for this 4 or 5 year perspective that we see here for Intel. Here's another look at one of those technical charts, and again, we just want to use this to make the point. And I went all the way back to 20 years ago. In fact, one of the first articles I wrote about any stock was Intel at Better Investing back in the 1994 timeframe. So actually recommended it for the stock selection committee and wrote the cover story about this one. So something that I've kicked around for a number of years. Here's the Go-Go 1990s for everybody that was part of it and can remember it. And we want to talk a little bit about these things that we're calling RSI breaks. RSI breaks, relative strength index breaks, and basically anytime a company has the pattern that you see up here at the top, where it's been potentially overbought for some period of time, and it can last for a long time, but at the point where it breaks back down through the 70 level, what we typically see is what we're displaying here. Again, a period of time where the stock price will either top out and maybe stay flat in the trading range for a while, or actually suffer a fairly significant correction downward. And as we look at chart after chart, company after company, we're beginning to build a case for a lot of times the size of this disruption. We refer to this this area right here as a disruption. The size of that is very often related to the size that you see up here. Not the case here. But in this one, we have another special condition where in the middle of 2002, after this first correction, at the turn of the century, we had this point where the short-term moving average crossed through the longer-term moving average. It's known as the death cross to the analysts and traders that trade the company. And basically what that does is magnify this situation, magnify either the amount of the drop in stock price or the length of the trading range. And then the other thing that you see here that we've talked about, a couple things here. This is kind of a poster child for the lost decade. The stock price has basically gone nowhere for 10 years, and that's what you see here on the chart. And the other thing that you see here on the chart is kind of part of this talk of this new normal stuff, because you had this is kind of a poster child for the growth of the late 1990s and this flattening out. And I personally believe that Intel is among the companies that will probably not go back to this type of a trajectory, but there's probably a date in the not too distant future, I have no idea when the S&P 500, known as Rip Van Winkle, wakes up and actually begins an ascent up again. And it'd be kind of nice to have Intel in the fold for that. So again, anytime you see one of these price breaks, and they actually had one not too long ago, approximately a year ago, and it sets up this period of disruption, again, where the stock price is going to languish and either drop or be in the trading range for a while. And again, if you want a little bit more on that, we invite you to go to our blog at expectingalpha.com and then look for the article called RSI Breaks. And then there's another one here that we penned just this past weekend called Cisco, Watch, Wonder, and Wait. And it basically walks through this type of analysis for a number of companies. And that's kind of a long way of agreeing with Hugh's statement that we wouldn't be the least bit surprised to see the stock price languish for this company for a while. But we do think that there's latent potential going forward, and that the long-term picture for those who accumulate stocks like this could actually be pretty good. Again, here's a reminder. It is the fundamentals that matter first and foremost. One of the reasons that our estimate down here for growth in that, let's just call it 8% range, is so strong is the value line estimate out here is kind of dragging this up a little bit. And included in the consensus estimates for the growth and profitability for the company. And again, keep in mind, as Hugh has already warned you, this is a growth cyclical company. If there's another recession, even if it's not the magnitude that we saw a few years ago, you're always going to have this during a recession. Dent down in the earnings, we know that the stock price will follow that. So with that, we'll just add a double dose of Intel to the portfolio. And again, if you want more on the subject, I would encourage you to check out the blog. It's free. And check a couple of these articles out. We're going to be talking about more of these type of patterns. And just seeing an awful lot of correlation, and I think something that could be a very reliable tool and resource for all of us. So with that, Ken, I think we can go ahead and first see if the audience would like to do the poll. And
well, I'm ready. We always give the audience a chance to add one of their choices based on our choices to the whole poll. So, Mark, are you seeing the poll right now?
I don't think I can, but hold on for a second. Yep.
Okay. So we invite you all to choose either adding Priceline or adding Intel or adding neither of these to the portfolio. We'll wait till about 80% of you have voted. Just take your mouse and click on the circle next to the name of the stock, and your vote will be recorded. We have 3/4 of the audience voting. We'll give you about 10 more seconds. It's painless, folks. Doesn't cost you a dime, so go on up there and make a click. And I'm going to close the poll now. And I'm going to share the results. And you'll notice that we're going to make a third position then in Priceline. 75% of you have decided to join Cy and me in adding Priceline. 20% Intel, and we have 5% of you that didn't like either one of them.
Yeah, I was kind of concerned that maybe none of the above was going to be a stronger candidate this month. But, well,
I'm going to hide, and we should be back to your screen now, Mark, I think.
Okay. And Hugh, I can't believe the audience, is not jumping on the McManus-Robertson bandwagon. But, it's their judgment. It's their vote.
I'm getting a hand in the air from Ann Manning. Ann, you're unmuted. Go ahead.
I just wanted to, I don't know if y'all are finished yet or not, but I just wanted to let you know that they announced yesterday, I believe, that their GlaxoSmithKline is going to build a manufacturing facility here in Texas at College Station, which is where Texas A&M is.
Wow.
I missed that. Who announced that? Was it Intel?
GSK.
Oh, GSK. Oh, okay.
Yeah.
Thanks a lot, Ann. This is the time when we normally wind up the program, but then the four of us will stick around to answer questions after the official close. So feel free to stick around if you wish. As usual, Cy and Hugh and Mark, thank you so much for helping us out at the March version of the Roundtable. I look forward to what's going to happen in April. And we'll stay online for another 10 or 15 minutes trying to get all the questions cleared. Thanks, guys.
Go Intel.